guys, welcome back to my channel and don't forget to like, comment, share and subscribe. The US Federal Reserve is hiking interest rates at the most aggressive pace in a generation, but the financial conditions it needs to tighten to tame soaring inflation are heading in the wrong direction. A rally in equities and falling government bond yields since the Fed's June hike means financial conditions are actually loosening. Despite the US economy having been hit with a combined 15 basis points of rate hikes at that meeting and the next one, financial conditions reflects the availability of funding in an economy. They dictate spending, saving, and investment plans of business and household. So, central banks want them to tighten to help control inflation, which is now running far above their target levels. A without followed US Financial Conditions Index (VCI) complete by Goldman Sachs, which factors in borrowing costs, equality level, and exchange rates, has loosened some 80 basis points since the Fed's June meeting. A similar index from the Chicago Federal Reserve, which tracks financial conditions independent of prevailing economic conditions, has turned negative, implying conditions are loose relative to what the current economic picture would usually suggest. In the Eurozone, conditions have also loosened by about 40 basis points, according to Goldman Sachs, and money markets have priced out most of the 2023 rate hikes they had previously expected. Back in June, we talked that US financial conditions were broadly where they should be to ignore the slowdown that you need to bring activity, wage growth, and price inflation back to target. Our best guess is that they've eased a little too much. The change in conditions has been driven by recession fears, which have prompted markets to not only reduce how far they expect the Fed to hike, but also to price in rate cuts next year. This suggests investors think the Fed will be more concerned by a slowing economy rather than inflation next year. Fed Chairman Jerome Powell's comments following the bank's July rate hike were also interpreted by some investors as implying a dovish pivot. Money markets now expect Fed hikes to stop at around 3% next March, compared with the 4% plus expected before the June hike, followed by some 50 of cuts by the end of 2023. Since the June hike, the S&P 500 has gained 30%, oil prices are down 20%, and 10-year US Treasury yields have fallen 70 bps. Credit markets have also rallied. To be sure, financial conditions are still some 200 bps tighter than late 2021's record low, and stock remain 10% down for 2022. Goldman estimate a 100 bps tightening in its VCI will crimp economic growth by 1 percentage point in the coming year. But the recent loosening is approaching what the bank terms and VCI lob Struven said. If you see very significant additional financial conditions easing, that will probably not be sustainable because the outlook for activity, wage growth, and inflation would look too hot. Okay guys, maybe that's all from me. Thank you for watching and don't forget to like, comment, share, and subscribe.